Today's Talk About It Tuesday question is, how do you analyze a real estate deal to determine whether or not the cash flow it will provide is worth the investment? So let me tell you where this question came from. Someone actually posted a deal in my Facebook group and asked whether or not it was a good deal. And I have to be honest, I didn't look at it well. And I looked at the numbers and I saw the monthly cash flow, and in my brain, it went to annual because I usually analyze things on an annual basis. And I quickly said it was a bad deal. And in retrospect, I have to rescind that answer. And I'm going to go through how to analyze a real estate deal so you understand why I changed my mind. So let me just, I'm going to post it. I'm going to post the original post in the comments so you can actually see the deal, but I'll tell you what it was. So a person bought a 4-unit building, and the purchase price was $485,000. The down payment was $31,000. So you might want to write this down so you can follow how we get to whether or not it's a good deal. So 4 units, $485,000, $31,000 down. The mortgage is at 7%, which is $3,900 a month. The total gross rents possible is $6,100 a month. The cash flow they estimated was $2,200 a month. So I have a formula that I use that will really determine whether or not something is a good deal. And they missed a lot of things. So I think they got lucky on the deal because there were certain things that they did not account for that they totally missed. So first of all, I never want to look at things in terms of a monthly basis. I want to look at it on an annual basis. And analyzing a real estate deal really comes down to what are you optimizing for? So the purchase price does not even matter if you're not optimizing for equity when you buy the property, meaning that you're not optimizing for buying something below market value and having, a higher market value when you buy it. So the purchase price doesn't matter. The down payment does matter because the down payment is the amount of cash that you have to come out of pocket with that's going to be parked in this property, right? It's an asset. So you're converting cash into an asset and expecting a return on that money that's parked into the asset. So if you're optimizing for cash flow, meaning you're optimizing for a specific return on your investment, then what does that number look like? And so for me, I usually tell people I want a minimum of any investment that I do, especially a hard asset like that, of a 10% return on my money. So if I put in $31,000, I want an annual return of minimally $3,100, right? Because I can get that in an index fund. So why would I tie it up in a building that's going to, be harder to maintain and be a lot more work and, much more risky to fire or damage and all these other things. So I would really rather have a 20% return. So a 20% return on my $31,000, right, would be $6,200 annually. And some of you are saying that's not a lot, but that's more than you'll get if you put it in the bank. It's more than you'll get usually in an index fund. It's less risky than putting it in stocks and trying to get it. So there are trade-offs, but 20% is a good return on your money. So if you put $31,000, you want to get $6,200 at least. And again, that's not monthly, that's annual. So I wrote down the numbers, and here's the formula. So if you're optimizing, again, for a return on your money, an annual return on your money, the first number you have to look at is the gross rents possible, right? If you had this place fully occupied for a year, how much could you get? So they said that they could get they said they can get $6,100 a month if it was fully occupied. $6,100 a month, you multiply that by 12, that's $73,200 a year. So that's where most people would stop. $73,200 a year, I'll take it. You can't stop there. The first thing you have to factor is what we call a vacancy factor. So you'll subtract 5% of that because there will be times when someone may not pay rent or times when your place will be vacant, meaning it's not occupied fully. And so you always have to estimate at least 5%. And depending on where you live, if there are a lot of vacancies, then you can actually increase that. But if you subtract 5% from that, that's $3,660 for the year. So now you're down to your gross rents possible, if not gross, your net possible 69,540. So that's the number you're working with. Still not what you're going to take home at the end of the year. What they didn't factor in are operating expenses. If this is a rental property, you have operating expenses. So you'll have your utilities, which could include heating, fuel, electricity, gas for the stoves, depending on the type of place that you have. So all of your utilities, water, sewage in New York, plus maintenance and repairs, property management. You should be running this thing like a business. You should not be plunging toilets and shoveling snow and taking out garbage yourself. Someone should be doing that. So if we do a very conservative estimate, and you should never have to estimate when you're really doing a deal, you should have these numbers pretty solid. You can talk to the previous owner and find out what they paid for these things. You can talk to the utility companies and see what the average is for places in that area, the size of the place that you have. But if we do a conservative estimate, we say $800 a month. Now, again, that's super conservative. That's $9,600 a year. So we subtract that. Also, now we're talking about $59,940 annual cash flow. But then we have the mortgage. So they said the mortgage is at 7%. We don't even care. That the percentage doesn't matter. At 7%, $3,900 a month. It only matters if the interest rates go down and you can refinance it and lower that number so you take home more cash flow. But right now, it doesn't matter. $3,900 a month is $46,800 a year. So now we have to subtract the $46,800 from the $59,940. That gives us what the annual cash flow would be, which is $13,140. So you can see we started out with a number 73,200, and now after all of our expenses, the annual cash flow is going to be 13,140, which is about $1,095 a month. So now the question is $13,140 a good deal? So if we have to look at what we put out of pocket. So we took $31,000 of our money, parked it into this asset, and it's given us $13,140 annually. What's our return on our $31,000? So when you do the math, now you divide $13,140 by the $31,000 that we put in, and that gives us a 45% return. I think that's pretty good. I'm sorry, 42%. That gives us a 42% return. 42% is phenomenal. So it's actually a phenomenal deal. And again, I looked at it really quickly when somebody posted it and I said, oh, it's not a good deal. I was looking at the monthly cash flow and assuming that was the annual. But as an annual cash flow, $13,140, when you only put up $31,000, is a great return on your investment. And that will be one I would pull the trigger on all day long. Of course, there are other factors, but just numbers wise, I'd pull the trigger on that one all day long. So that's how you analyze a rental income investment property. So hopefully that makes it easier for you to understand. I'd like to hear your comments, your questions, further questions about it, how you analyze your deals. Please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.